Anyway, I think that's what I'm going to do now is I want to really turn now to, I think, really the key point, and that is bringing, I think, kind of the long-run impacts that are going to impact on Alberta. And here I want to, I'm going to go back to this cost comparison by province, but I want to say some things about more of a longer-term nature. And the question is, what's going to happen over the next number of years as Alberta has to deal with a rather difficult fiscal framework that it really has had a great deal of problems in trying to deal with, and that's with respect to the volatility of revenues. Now, first of all, one of the things I want to first talk about is that there has been forecasts on what will happen to Alberta tax levels over the next 20 years. And the forecast in that is really the following, is that if one takes into account that government spending rises by GDP, let's say on average about, at least in the past 10 years, that would be about 5.6% per year, plus you allow for demographic pressures on Alberta spending, particularly with respect to healthcare, which is already over a third of the Alberta budget when it comes to program spending. As well as actual pressures in education, where education spending has been rising faster than other components of the Alberta government budget. When you take those factors into account, and make the assumption that Alberta will always balance its budget so that it will run no debt, what the forecast will tend to show is that average tax levels in Alberta will rise from about 8% of GDP to 10% of GDP by 2020. That would be about a 25% increase in taxes. And in doing this kind of calculation, what you show is that all the savings that Alberta would be wiped out over this period, including the Alberta Heritage Fund, and also you would show that but Alberta would avoid running any debt. There would be no debt issues involved during that period as well. So it would be strictly balanced budget growth, but using up all the net savings that are there. That 25% increase in the marginal effective, or in average tax levels, if that translates into also an increase in the marginal effective tax rate on labor and capital, what you're then talking about is a marginal effective tax rate on capital rising from about 18.5% let's say in 2013 to 24.8% by 2020. The marginal effective tax rate on labor would increase to 47% from 39% over the next 10 years as well. All that suggesting that Alberta's tax advantage could be significantly impacted. And why is that? Why would that happen? Well, part of it is the demographic changes, the aging in society that is going to push up tax levels because retired people need more spending, but also they don't pay as much taxes when they're retired as when they're working. And so just changing the composition in society to more elderly people actually means that tax levels are going to go down naturally. So in order to make up for that, you have to raise taxes on the working population. And also it also means is that the other reason why the tax levels are going up is that resource royalties have historically and are projected not to rise as fast as GDP. So effectively there's an unfunded liability in the sense that those resource revenues will not rise as much. And that's a pressure that Alberta faces that is not the latter one, that is quite different than what other provinces face because of the fact that resource royalties do not grow as much. And this is this kind of analysis is based on the work that I did. Dan Halick is here today. We were commissioners on the looking at Alberta savings policy, and I thought this was probably one of the most important analyses that we did in the whole report, was looking at this projected tax levels that are going to be faced by the government over time. And so then the question becomes, what do you do about it? And what you do about it is really there are only three things that you can do, and it's really the same debate that you're seeing in the United States with the very large fiscal deficits today. Governments, if you want to avoid raising taxes there's only two other policies that could be done to avoid raising taxes over the next 10 years and to maintain that Alberta advantage. One would be to raise debt, and that's what a lot of provinces do. They have a lot of debt financing, and so effectively they've pushed tax increases onto future generations in doing that. The problem for Alberta is that effectively we're already doing that with their use of resource royalties, because resource royalties is the payment that the government of Alberta gets for selling oil and gas that's in the ground, and when you sell off your asset in the ground and the Alberta government collects resource royalties, effectively it's using its capital to finance current consumption with resource royalties. And what many people have often argued is that, if anything, Alberta should be saving those resource royalties, putting it into a financial account so that it could pay for goods and services, public services that would be available for future generations, as well as existing taxpayers in the future as a result of doing that. And of course, that could be a debatable point, but the main thing is that in Alberta, if we end up doing debt financing, we're not only selling off our capital assets in the ground to finance our current consumption, but we also start engaging in debt financing to pay for those to pay for the current expenses as well. So we're just adding on our liabilities and using up our net assets as a result. So if you take the view that you don't want to increase debt financing, then that leaves only one thing left, and that is to constrain spending. So I did a little calculation to ask the question, what would happen if we constrained spending such a level that we didn't increase taxes at all in the province, and so that we could maintain at least the tax advantage we have with respect to labor at this point. And what I found is that over the period from 2008 until 2020, so this is sort of ignoring the current recession right now and the implications for the fiscal balances of the province, because that's a downturn that could be made up with an upturn later on. So it's kind of an average calculation. What I found is that you'd have to constrain spending for 12 years by 2.5% per year. That's actually less than population and prices. This is to avoid any tax increases and to avoid debt financing. So that is actually a pretty tall order when you look at healthcare spending, education spending, which roughly are about over 60% of Alberta's budget in trying to do that. And so these fiscal choices are going to be extremely important over the coming while. And the key will be for the Alberta government to settle on a fiscal planning framework that works not just during the periods of a downturn, but also work during periods of the upturn, and not seeing the kind of ramp up of spending that we saw in the past 10 years, where spending was 8% per year, more than the growth in the economy, which was only 5.6% per year. That's been the record that we've seen over the past number of years. And so we do have to think about how we're going to deal with these various constraints over time. Now, of course, this also suggests, this calculation, by the way, would assume no increase in savings, net savings of the province, that 2.5% constraint. So if the province also wanted to put more money aside into savings accounts, it would have to constrain spending even further than allowing 2.5% increases. And so, so the other part of the fiscal framework is what to do with resource revenues and how to deal with them over time. Now, that's all well and good, but there's still a problem here. And even though, even if we try to constrain spending, we will have an issue with respect to capital, because effectively Alberta will have a capital taxation of capital that's actually no longer an advantage in this country, and in fact really is kind of in the middle of the pack of all OECD countries anyway around the world. So we're not tilting the playing field for adding in capital investment. In fact, what I'm going to show with the work that we've done in oil and gas taxation is that once you take into account both the royalty systems and the tax systems, in terms of their impact on the marginal, or the incentive to invest in capital in the oil and gas industry, that actually oil and gas investments are taxed more highly than other sectors of the economy. And so actually when you start adding that in, there's actually a clear Alberta disadvantage when it comes to capital investment. But that will be sometime in this fall when I'll be presenting that work.